So we are not a transactional practice, okay? And this is very, very important. We're a teaching practice. The most important thing to me is you understand this concept, because this could be something that's right for you if you understand it. Again, like I mentioned in my previous videos, I can teach you products all day. This is a superior product, in my opinion, superior than anything out there. But if you don't know how to use it properly, then you're not going to be efficient with it, okay? So we're not a transactional practice, we're a teaching practice. The most important thing to me is you understand these concepts that we're trying to teach here in these lessons, okay? So today we're going to talk about life insurance. We are going to buy life insurance, right? When you buy life insurance, it can either be a bill or we can structure it this way, and it can be part of your building wealth plan, on your financial plan. So when we buy life insurance and we structure it the right way with the right mutual company, it's going to have cash value the first year. And this is what this represents. This green tank represents that cash value. Now, once those premium dollars are paid, a portion of the premium dollar is going to end up here in this tank. Okay, it's going to end up here in this tank. Once it ends up here in this tank, it's going to earn interest. More importantly, its interest is going to earn interest. Not only we're talking about simple interest, we're talking about compound interest. So once the interest is earning interest, that's what we call compound interest. That's what Einstein called the eighth wonder of the world. It's a place where you put your money in and it gets better and better every day. You can't stop it. It gets better and better every day. So now that our money is sitting in this green tank, once it ends up here, we're putting it in a position where it has uninterrupted compounding of interest, okay? Uninterrupted compounding of interest. That's the key to this. Now, why is this important? It's important because whenever you look at the compound interest curve, and I don't know if you learned this in elementary school or in high school, but when we're in school and we're looking at this compound interest curve, in the beginning, it's kind of like watching paint dry, right? It's like watching paint dry. The growth is very slow. The growth is very slow, but when it has a chance to take off, the growth is astronomical in your later years. So when you're looking at it, there's nothing magical about it. Year 1, year 2, year 5, nothing magical about it. But once you get to that year 10, year 15, year 20, this is where it has a chance to take off. This is where the magic happens, okay? So understanding this, understanding compound interest curve, and it's a long-term play, we're going to put our money in a position where it has uninterrupted compounding of interest. Why is that important? Like we talked about earlier, when you save money, okay, when you save money right now, how does it work? You put it in a savings account, you drain the tank, you pay cash. You put it in a savings account. What is that savings account earning you today? Less than 1%. You go to Wells Fargo, you go to Chase, you go to Bank of America. Less than 1%, okay? Knowing that and understanding the compound interest curve that we just talked about in the other video, the true cost of paying cash, okay? How often do you want to reset your compound interest curve? Never, right? The answer is never. You never want to reset your compound interest curve. That's why this is so powerful. So there is no place in the world where you can do that, okay? If you save your money in a CD or in a savings account or wherever you put your money in, every time you use it, you start over. You start over, right? That's the magic of this policy, guys. That's the magic of this infinite banking private reserve policy. And when you need the money, okay? And when you need the money, you don't have to find a financial institution to negotiate with, like, or to qualify with a credit card company. You don't have to go to the bank. You don't have to talk to somebody, apply for a loan. You don't have to give your tax returns, your 2-year, 3-year tax returns, pay stub, credit check. If you have a business, P&L statement, you don't have to do any of that. The insurance company is not going to do that. They're simply going to write you a check. No questions asked. Or they could just wire it to your account. 3 to 4 business days, wire to your account, done. It's as easy as that. Okay? That's how important this insurance company is to this process. This is how important this insurance company is to you. That's the kind of relationship you have with this insurance company and your money. Okay? It's a unilateral contract and you control that piece. I want you to think about that. Okay? You have the first right of refusal on your cash value inside your policy. You basically made an employee of the insurance company. Your own private reserve secretary, right? Your own banking secretary. Like, you just made the insurance company your secretary. Whenever you need the money, they just send you a loan with no questions. I want you to think about that for a minute. Your own private secretary that does the banking function for you whenever you desire to use it, whenever you jump in, right, to have a major capital purchase or an investment opportunity. Think about that for a minute. You have the insurance company here, right here, okay? That means if you borrow money from the insurance company, they're simply going to put a lien on that money. That's all they're doing. They're just putting a lien on that money, okay? They're not encumbering the tank, meaning if you have $100,000, $200,000, $500,000 in there, that's still gonna grow at that level. You're not encumbering the tank. Like, I have a real estate investor, a friend here in Houston, and all he does, I think he has like $700,000 in his policy cash value. He's not encumbering it, but what he does is he lends it to his money is growing at 5%. He lends it to other real estate investors for 2% and 12 points. His money is earning 5% and he's using other people's money to make 12% and 2 points in that money. Think about that. Think about the numbers on that, okay? So you're not encumbering the tank. It continues to get better and better every day. Even when you're collateralizing, when you're using that money, right? So when you use that money to buy real estate, enter the stock market, major capital purchase, it's time to repay the loan because, I mean, you paid everybody your entire life, right? So treat yourself like you would treat any other financial institutions, okay? So how would that look like? The payment is unstructured. You control that piece, okay? Non-structured payments. You decide how much you're gonna pay every month. You decide. $0, $1, $50, $100, you decide that. So whenever you have investment opportunities, sometimes you might have to wait, right? So when you're creating a loan, you almost have two brains. You know, you have your banking brain and then your saver brain. So you're saving money, and then when you're getting a loan, you have to kind of switch on because now you are the president of your own bank. That brain is going to get switched on. Am I going to approve this loan? Is this loan going to make me more money? And if it does, you don't know when that money is going to come back because it's an investment, whether it's in the stock market or real estate. That payment is unstructured. You control that piece. You decide how much you want to pay. So whenever I usually describe this, because people get confused whenever I say this, that they always say, oh, I have to take a loan on my own money. What do you mean by that, Joe? How is that beneficial? Think about it this way. Again, just going back to how often do you want to reset the compound interest curve? You already know that. The answer is never reset it, right? But if you're saving money, let's say you're putting your money in a shoebox, okay? And you use it for a major capital purchase. How do you feel? Okay? What would make you feel better? Most savers, what would make them feel better is they're not going to feel good until the shoebox is full again. This is your rainy day fund, right? So if you have the same mindset and you already have a shoebox, you're already saving money, and then you paid cash for something, you're not going to feel good until that shoebox is back to whatever 6 months reserve you're thinking of, right? To make you feel comfortable. Same concept, except every time you pay cash, you're resetting that shoebox. You're going back to zero as far as the compound interest curve. You never want to do that. It goes back to the true cost of paying cash, okay? So you're not going to get comfortable until the shoebox is filled again. So when you have a loan on your policy, you're going to pay that loan back how you would treat yourself or how you would treat any other financial institutions, because you are now controlling the banking function that they're allowing you to do that, right? Your money is sitting somewhere where it's earning a certain amount, and you're borrowing your money and using that at a lower rate. So now you have interest arbitrage. Your money is always going to be higher than what you're using this for whatever this is, whatever investment this is. Your money is always going to be sitting in this tank growing much higher than what you could have. $1 million growing in your tank at 5%, and you borrow, let's say, $500,000 for an investment, your tank is still earning 5% at 1 million. And you're over here using this, right? For whatever reason. So very important piece. So this is a very, very important piece, this non-structured loan payment piece. Because again, like think about the car dealership, right? If you go to the car dealership, they tell you what? Pay the car in full anytime, but if you as long as you pay the payment the first day of the month, and if you miss the payment, what are they gonna do? That loan itself is amortized loan, right? They're gonna tell you like how you need to pay it back. If you miss a payment, you're gonna get nasty phone calls. They're gonna repo your car. So our process, like this process, you decide when and how you're going to pay that back. Okay, which is a very, very important. You control this piece of how to pay that loan back. So as a president of your family bank, you decide how you're going to pay that loan back. This is very important because everybody's under the gun whenever whenever you're doing an amortized loan. Before, like for example, like I said, like either it's a house, either it's an investment, it's a real estate deal, or either it's a car. The picture that I want you to understand is your money is in this green tank. Okay. That's the picture that I want you to understand. And it's growing. And how you borrow from the insurance company and how you pay it back to the insurance company. So imagine this, okay? Like again, that's a control piece right there. And you just keep on doing this. That's it. That's how simple the strategy is. So if you're borrowing it, if you're earning 5% and you're borrowing it at 5%, what is that? What's the cost of your money? Zero, and your money is still here, sitting, growing. Right? So this is the important piece right here. That's how simple it is. It's so simple, it's counterintuitive.